What if I told you that the metal coating the mirrors in your bathroom, the same element used in your smartphone's circuitry, and the solar panels increasingly dotting American rooftops just hit a price level that historically precedes the kind of wealth transfers that reshape entire communities? On December 12, 2025, silver touched $64.20 per ounce. That's not just a number on a screen. That represents a 91% gain from where we stood exactly 1 year ago. And buried beneath the headlines about record prices, there's a story unfolding in Canadian mining operations that I believe deserves far more attention than it's currently receiving. Let me walk you through what the data actually shows, because the real story here isn't about price charts. It's about geology, industrial demand, and the mathematical reality of pulling finite resources from the Earth's crust. Before we dive into the current situation, I need to establish some historical context that I think fundamentally changes how you should interpret today's silver market. The element we call silver has been valued by human civilizations for approximately 5,000 years. The ancient Egyptians considered it more valuable than gold. The reason was simple geography. Egypt had accessible gold deposits in Nubia, but silver had to be imported from distant lands. This historical footnote matters because it illustrates a principle that remains true today. Value is determined not by inherent properties alone, but by the relationship between supply and accessibility. The United States operated under a bimetallic monetary standard until 1873, when Congress passed what became known as the Coinage Act. This legislation effectively demonetized silver, and historians still debate whether this was intentional policy or legislative oversight. What's documented is that the silver mining interests of the American West never forgave this decision. William Jennings Bryan's famous Cross of Gold speech in 1896 was fundamentally about silver remonetization. The political passions that metal generated reshaped American politics for decades. I mention this history because it provides perspective on what we're witnessing now. Silver at $64.20 is not unprecedented in inflation-adjusted terms. When the Hunt brothers attempted to corner the silver market in January 1980, the nominal price reached approximately $49.45 per ounce. Adjusted for inflation using Bureau of Labor Statistics data, that 1980 peak would equal roughly $188 per ounce in 2025 dollars. So, despite the headlines about record prices, we're still trading at approximately 1/3 of the inflation-adjusted all-time high. This context matters because it tells us something important. The current price level, while historically elevated in nominal terms, is not in bubble territory by historical standards. The market appears to be repricing silver based on fundamentals, not speculation. Now, let me walk you through what happened on December 12th and why the Canadian mining sector response is particularly significant. According to Kitco News reporting from that date, silver bulls had their foot on gas as the metal reached $64.20, establishing a 7-week high. The Toronto Stock Exchange responded with notable strength, with the mining sector rising approximately 2.5% in a single trading session. When I examined the TSX composite data, Canadian silver and precious metals miners were leading the broader market rally. This 91% year-over-year gain that we're observing didn't happen in isolation. It reflects a fundamental shift in how institutional capital is viewing the silver market. According to data compiled by the Silver Institute and publicly available through their annual surveys, 2025 marks the 5th consecutive year of structural supply deficits in the global silver market. Let me explain what a structural deficit means in practical terms. Every year, the world's mines extract silver from the ground. Every year, industries consume silver in manufacturing processes where the metal cannot be economically recovered. Every year, investors purchase silver for storage. When consumption and investment demand exceeds new mine supply plus recycling, you have a deficit. That deficit must be filled by drawing down existing above-ground inventories. The cumulative deficit since 2021, according to Silver Institute data, now exceeds an estimated 600 million ounces. To put that in perspective, total annual mine production globally runs approximately 844 million ounces. We've effectively consumed almost an entire year's worth of global production from existing stockpiles over the past 4 years. This brings me to the Canadian mining story that I believe mainstream financial media is underweighting. Silvercorp Metals, a Vancouver-headquartered company with primary operations in China's Henan and Guangdong provinces, released an operational update in early December 2025 announcing record silver production. Their Ying mining district, which has been in production since 2004, achieved throughput levels that management described as historically unprecedented. What makes Silvercorp's situation noteworthy is the grade of ore they're processing. According to their publicly filed technical reports, the Ying mining district produces silver at grades exceeding 300 grams per ton. For context, many silver mines globally operate at grades between 100 and 200 grams per ton. Higher grades translate directly to lower production costs and higher margins at any given silver price. The second Canadian operation worth examining is Hecla Mining's Keno Hill project in Yukon Territory. Hecla, while headquartered in Coeur d'Alene, Idaho, acquired this Canadian asset through their purchase of Alexco Resource in 2022. Keno Hill represents one of the highest-grade silver deposits in North America, with historical production dating back to 1913. According to Hecla's most recent quarterly filings, Keno Hill is now contributing meaningfully to their consolidated production numbers. The mine produces silver at grades that rank among the top 10 globally. When I reviewed the technical data, average grades reportedly exceed 700 grams per ton in certain areas of the deposit. These are exceptional numbers by any standard, but here's the mathematical reality that I think investors are beginning to understand. Even with record production from high-grade operations like Silvercorp's Ying District and Hecla's Keno Hill, global mine supply appears insufficient to meet current demand. The Silver Institute's projection of approximately 844 million ounces of mine production for 2025, even when combined with recycling flows of roughly 180 million ounces, falls short of estimated total demand. Industrial demand represents the fastest-growing component of silver consumption. According to data I've reviewed from multiple industry sources, photovoltaic cell manufacturing consumed approximately 234 million ounces in 2025. This represents an increase of roughly 18% compared to 2024 levels. The growth driver is straightforward. Silver paste is applied to the surface of solar cells to conduct electricity. No commercially viable substitute exists that matches silver's combination of conductivity and durability. Electric vehicle production adds another layer of demand. Each conventional internal combustion vehicle contains approximately 0.5 to 1 ounce of silver. Electric vehicles, by contrast, contain an estimated 1.5 to 2 ounces due to their more complex electrical systems, battery management units, and charging infrastructure. With global EV sales continuing to grow, this demand source consumed approximately 78 million ounces in 2025, representing a 22% year-over-year increase. The newest and perhaps most underappreciated demand driver is data center infrastructure. The artificial intelligence boom has triggered unprecedented investment in computing facilities. These data centers require massive amounts of electrical connectivity, and silver's superior conductivity makes it the preferred material for high-performance applications. Industry estimates suggest data center-related silver consumption reached approximately 41 million ounces in 2025, an increase of 37% from the prior year. Let me share some unusual facts about silver that most investors don't know, because I believe understanding the metal's unique properties helps explain why substitution is so difficult. Silver possesses the highest electrical conductivity of any element. It's approximately 6% more conductive than copper. While this might seem like a small advantage, In applications where efficiency losses translate to heat generation and energy costs, that 6% matters enormously. Data centers already consume approximately 1.5% of global electricity. Any efficiency gains in electrical transmission translate directly to operating cost savings. Silver also has the highest thermal conductivity of any metal, which is why it's used in high-performance thermal interface materials for electronics cooling. As chip manufacturers push transistor densities higher, thermal management becomes increasingly challenging. Silver-based solutions command premium prices because they work better than alternatives. Perhaps most surprisingly, silver is the most reflective element across the visible light spectrum. This property makes it essential for mirrors, but also for emerging applications in directed energy systems and advanced optical computing. The James Webb Space Telescope uses gold-coated mirrors because gold reflects infrared radiation better. But for visible light applications, silver remains unmatched. Here's a fact that genuinely surprised me when I first encountered it. The average American smartphone contains approximately 0.35 grams of silver. With over 1.4 billion smartphones sold globally each year, this represents roughly 16 million ounces of annual demand from a single product category. Most of this silver is not economically recoverable due to the complexity and cost of dismantling electronic devices. Returning to the market data, BNP Paribas reportedly established a $100 per ounce price target for silver by 2026. This projection, if accurate, would represent an additional 55% upside from current levels. Their analysis, according to available reports, emphasizes the combination of constrained supply growth and accelerating industrial demand. The Kitco News commentary on December 12th noted that some market observers suggest buying on dips above the $63 level. This is consistent with technical analysis principles. When an asset establishes a new high, the previous resistance level often becomes support. The $63 level appears to function as a psychological floor in current trading. I want to address the supply side of this equation more thoroughly, because I think the constraints facing silver miners are underappreciated. Approximately 70% of global silver production occurs as a byproduct of base metal mining. When companies mine for copper, lead, zinc, or gold, they frequently recover silver as a secondary product. This creates an unusual supply dynamic. Silver production is largely determined by decisions about copper and zinc mining, not by the silver price itself. Primary silver mines, operations where silver is the principal product, represent only about 30% of global supply. These mines are concentrated in a handful of countries. Mexico leads global production, followed by Peru, China, Poland, and Russia. Canada, despite hosting some of the world's highest-grade deposits, ranks lower in total production due to the relatively small scale of its operations. The implication is that even dramatically higher silver prices may not stimulate proportional supply increases. If copper prices remain stable, copper miners won't accelerate production simply because silver prices rise. The silver they recover is profitable at any positive price, but it's not the driver of their investment decisions. New mine development faces extended timelines. From initial discovery to commercial production, the typical development cycle runs 7 to 12 years. This means that supply responses to current price signals won't materialize until the early 2030s at the earliest. The geological, permitting, and financing processes cannot be meaningfully accelerated regardless of how high prices rise. Let me share some perspective on what these TSX mining gains actually represent. A 2.5% single-day move in mining equities might not sound dramatic, but mining stocks are leveraged plays on commodity prices. A 10% move in silver prices might translate to a 30 or 40% move in the share prices of silver miners due to their operational and financial leverage. The relationship works like this. If a mining company produces silver at a cost of $15 per ounce and sells it at $30, their profit margin is $15 per ounce. If the silver price rises to $60, Their profit margin increases to $45 per ounce. That's a tripling of per-ounce profitability on a doubling of price. This leverage explains why mining stocks exhibit such dramatic volatility relative to the underlying commodity. Canadian mining companies face specific advantages and challenges that differ from their competitors in other jurisdictions. The advantages include political stability, established rule of law, and access to skilled labor. Canada's mining regulatory framework, while sometimes criticized for permitting timelines, provides legal certainty that miners in some other jurisdictions lack. The challenges include high labor costs, extreme weather conditions in many mining regions, and increasingly complex environmental requirements. Yukon Territory, where Hecla's Keno Hill operates, experiences winter temperatures that can reach -40 degrees. Operating in these conditions requires specialized equipment and procedures that add to production costs. When I examine the geological fundamentals of Canadian silver deposits, several facts stand out. The Yukon's silver endowment is genuinely world-class. The Keno Hill district has produced silver since 1913, with historical production exceeding 200 million ounces. Despite this century of mining, substantial resources remain. British Columbia hosts the Bruce Jack Mine, operated by Newmont Corporation following their acquisition of Newcrest Mining. While primarily a gold operation, Bruce Jack produces silver as a byproduct at grades that rank among North America's highest. Ontario's mining heritage includes the Cobalt Mining Camp, which was historically one of the world's great silver districts. Production peaked in the early 20th century, but exploration activity has resumed as higher prices make previously uneconomic deposits worth reassessing. The Federal Reserve's monetary policy decisions continue to influence precious metals prices through their effect on real interest rates. On December 11, 2025, the Fed cut interest rates by 25 basis points, continuing a pattern of accommodation that began in late 2024. Forward guidance suggested additional cuts of 50 to 75 basis points remained possible through 2026. Lower interest rates reduce the opportunity cost of holding non-yielding assets like silver. When Treasury bonds pay 5%, holding silver means foregoing that income. When Treasury bonds pay 3%, the relative attractiveness of silver improves. When real rates, meaning nominal rates minus expected inflation, turn negative, precious metals historically outperform. According to my calculations using Treasury yield data and inflation expectations derived from TIPS spreads, real yields on 10-year Treasuries stood at approximately negative 0.3% as of mid-December 2025. This environment has historically been favorable for silver. Academic research I've reviewed suggests silver averages gains of roughly 28% annually during periods of negative real yields, based on data spanning the past 4 decades. The China factor deserves attention because it influences both supply and demand dynamics. China is simultaneously a major silver producer through operations like those Silvercorp manages, and a major silver consumer, particularly for photovoltaic manufacturing. Chinese solar panel production reportedly exceeds 80% of global capacity, meaning shifts in Chinese industrial policy directly impact silver demand. Shanghai Gold Exchange data provides real-time information about Chinese silver market conditions. When Shanghai premiums exceed London spot prices, it typically indicates strong physical demand and tight local supply. According to available data, these premiums briefly reached elevated levels in late November and early December 2025, though they moderated somewhat by mid-December. I've spent considerable time examining the historical patterns that might help us understand current market dynamics. The 1970s provide one template. Silver rose from approximately $1.50 per ounce in 1971 to nearly $50 by January 1980, a gain of over 3,000%. That move occurred against a backdrop of high inflation, monetary instability, and eventually the Hunt brothers' attempted corner. The 2009 to 2011 period provides another template. Silver rose from approximately $9 in late 2008 to nearly $50 in April 2011, a gain of roughly 450%. That move occurred against a backdrop of quantitative easing, zero interest rates, and concerns about currency debasement. The current move, from approximately $23 in October 2023 to $64 in December 2025, represents a gain of roughly 180%. By historical standards, this move remains modest compared to previous silver bull markets. What strikes me most about the current situation is the convergence of factors that weren't present in previous cycles. Industrial demand is structurally higher and growing faster than at any previous point in silver's history as a traded commodity. Supply constraints appear genuinely binding, not merely a function of underinvestment that will correct with higher prices. Institutional participation, evidenced by ETF flows and positioning data, has reached levels that suggest this is not primarily a retail-driven phenomenon. The Canadian mining sector's response to these dynamics reflects prudent capital allocation by management teams that have witnessed multiple commodity cycles. Rather than aggressive expansion that might prove ill-timed if prices correct, most operators appear focused on optimizing existing operations and maintaining balance sheet strength. For those interested in understanding these markets more deeply, I plan to continue analyzing the data and sharing my interpretations as conditions evolve. The silver market is telling us something about the relationship between finite physical resources and expanding industrial applications. Whether prices continue rising, consolidate at current levels, or correct significantly, the underlying supply and demand fundamentals will continue generating developments worth examining. If you found this analysis valuable and want to stay informed as the situation develops, I encourage you to subscribe and enable notifications. I'll be releasing updates as key data points emerge, particularly around contract expiration dates and major inventory reports. Drop a comment below sharing which aspect of the silver market you find most compelling, or which data point you're personally tracking. I read every comment and respond to thoughtful analysis. Your engagement helps shape future content and ensures we're addressing the questions that matter most to this community. See you in the next breakdown.